In this video, I'm going to show you the journal entry to record interest received. Now, a company can receive interest in several different contexts. It might have lent money, it might have purchased an interest-bearing investment, or it might simply have money in an interest-bearing bank account. Now, here's the common theme across all these situations. Companies are going to need to do two things regarding this interest. First, it's going to have to accrue interest revenue when the interest is earned. And second, it's going to need to increase its cash account when it actually receives the interest. Now, I'm going to do two examples. And in the first example, both of these things are going to happen at the same time. But then I'm going to show you a little bit more complicated example where these two things do not happen at the same time. So let's start with a simple example. So your bank informs you that your business earned $50 of interest this month on your business savings account. Okay, so you've got the money in your account, so you debit cash for $50, you credit interest revenue. Some people prefer to say interest income, they mean the same thing. Okay, so you debit cash for $50, assets go up, you credit interest revenue, that increases the company's net income, it increases stockholders' equity. So assets go up, equity goes up, the company's profit goes up. End of story. Okay, you're receiving the cash, accruing the interest revenue at the same time. Now, in our next example, it's a little bit more complicated, but hang with me, it's not too bad. So, we're going to have a situation where your company has lent money, $100,000 cash, to a supplier in exchange for a note. And let's say that they lent the money on January 1st and that the money is going to be due in 12 months. So this is going to be a 12-month note. The annual interest rate on the note that you're charging the supplier is 8%, and both the principal, which is the $100,000 you're lending out, and all of the interest are going to be due on December 31st, so the end of the year. Now, your company, and this is critical, your company is going to make adjusting journal entries on a quarterly basis. So we're assuming your company puts out quarterly financials, which means at the end of each quarter, they're going to need to accrue interest revenue, even though they haven't received any cash yet for interest. Okay, so that's what makes this a little more interesting. Now, January 1st, to record the issuance of the note, you're going to debit note receivable. It's an asset, credit cash for $100,000. So one asset goes up, one asset goes down. Now, here's the thing. March 31st, 3 months have passed. You need to make your quarterly financials. You need to make an adjusting journal entry. You're going to debit interest receivable, not cash, because we said that the terms of the note was the interest isn't due until December 31st. So you're going to debit, instead of cash, interest receivable for $2,000. And then you're going to credit interest revenue for $2,000. Now, if you're wondering how I came up with the number $2,000, we take the $100,000 that you lent out, multiply it by 8%. But remember, that is an annual interest rate. So $8,000 would be the interest for the whole year. But only 3 months have passed, so only 3 months of interest have been earned. So we take 3 months out of the 12, so 3/12 times 8,000 is 2,000. So that's where I came up with that number, 2,000. Okay, so your company is going to accrue interest revenue of 2,000, but hasn't received any cash yet. Same deal on June 30th at the end of second quarter, and on September 30th at the end of the third quarter. You notice that your company is making the same journal entry each time as they accrue interest revenue, but they have not received any cash. December 31st, however, that's the day where your company is going to receive cash, and they're going to receive the $100,000. Okay, so they're going to receive $100,000 that was originally that they lent out, plus the entire year's worth of interest, which was $8,000. So your company's going to debit cash for $108,000. Now they're going to credit note receivable for $100,000 because the note is no longer receivable. We're assuming you got the money. We're going to credit interest receivable for $6,000. Why? As we had debited it here, we had debited it here, we had debited it here. It's no longer receivable. You're getting the money, right? It's in that $108,000. So we credit interest receivable for $6,000, and we make the final accrual of interest revenue for $2,000.